Hello, I'm Vito Taphorn from the Private Bank, and today I'm here to discuss commercial mortgage calculations and decisions. Three of our main points that we're going to discuss today. First, we're going to define leverage and why real estate investors like to use it. We're going to discuss loan-to-value, debt service coverage ratio, and debt yield, as well as other metrics that are used to determine the amount of leverage that an investor can place on an asset, and the amount of leverage that a bank is willing to lend on an asset. And we're going to use an example of the acquisition of an apartment asset over 3 separate periods of time to explore how those metrics change the financing decisions. First of all, what is leverage? Leverage is a fancy word for debt. Debt financing allows real estate investors the ability to borrow funds to purchase or construct an asset without using cash or equity from their own pocket. What are the major sources of debt financing? There's conventional financing, which is normally referred to as senior debt. That's provided by commercial banks, insurance companies, commercial mortgage-backed securities, and pension funds. There's another sect called unconventional financing, or subordinated debt. That's usually provided by hedge funds, mezzanine debt providers, and hard money lenders. And then there's the numerous government programs and incentives that are there to spur development throughout the community, such as TIF financing, tax-exempt or taxable bonds, tax credits, both new market tax credits and historic tax credits, and agency debt, HUD, Fannie and Freddie. Senior debt frequently is used in the form of a senior note or senior mortgage, and it provides the first lien priority over any other debt that may be placed on a property. It's always secured with collateral on which the lender puts the first lien or mortgage, and it, as we mentioned, is the highest seniority in a capital stack. We'll touch on mezzanine debt as that is part of our example of the acquisition over a period of time. Mezzanine debt is usually referred to as subordinated debt, and it is a middle part of the capital stack between the senior debt piece and the borrower's cash equity. Mezzanine debt was very prevalent in the early 2000s before the Great Recession that allowed borrowers to purchase or construct assets with even less cash equity. This would take a slice between what is normally referred to as a senior piece, between up to about 75 or 80% of value, and allow for a middle placement of higher priced, higher risk debt to be layered in above the borrower's cash equity position. We've seen mezzanine debt come back slightly over the last couple years as we're climbing out of the Great Recession, but it's still not even close to as prevalent as it was before. So we'll go into some definitions, and first let's go back to a concept discussed in a previous video, which was net operating income. Net operating income is the income that remains after all operating expenses are deducted from effective gross income, but before mortgage debt insurance. This slide shows the calculation of potential gross income less vacancy collection loss equals effective gross income less your operating expenses gets you to NOI. NOI is important because from NOI you can determine either your cap rate or your value. So to determine your cap rate, you would take the value of the asset or the purchase price and the NOI to determine what the cap rate is. In this example, we show $1 million NOI with a $10 million value, which translates to a 10% cap rate. If you have a cap rate from a comparable property or an appraisal on a similar property, you can use that to determine your value by taking net operating income over that implied cap rate to come up with value. Value is very important in making a mortgage decision because one of the key criteria that any lender is going to use is a concept called loan-to-value. Loan-to-value is the relationship between the level of debt and the value of that property. Banks usually apply different loan-to-values based on the property type and perceived risk or cash flow of an investment or acquisition. And keep in mind that the purchase price, the value of the purchase price is also determined from an appraisal. So usually lenders will take the lower of the appraised value or the acquisition of the asset to determine what the value is and then apply the appropriate loan-to-value ratio to that. If we look at this slide, it shows different property types and what the bank's policy or standard loan-to-value is on those property types. So raw land usually carries a 50% loan-to-value. Improved land, which means some level of grading or road service, sewer, utilities to the site, will provide a 65% loan-to-value. Commercial construction or acquisition of retail, office, and industrial usually carries a 75% loan-to-value maximum, and multifamily pushes that to 80% because of its perceived less risky asset. The second major calculation that is used when determining the amount of financing to be placed on a certain property is a debt service coverage ratio. And this is the relationship between net operating income and the debt service of a given loan. Typically, commercial lenders require a standard of about a 1.20 times debt service coverage ratio to determine their level of debt. So in a very short example, for every dollar of debt service, which is your mortgage payment, the property must contribute $1.20 in cash flow to support that payment.